Hello investors, welcome to the channel. Here I talk about long-term investing in companies that pay a dividend. This is known as dividend growth investing. My name is Doan, and today we're going to take a look at how the market ended for the week and then look at stock futures. Just taking a quick look at the major indices for the week. For the S&P 500 index, it is down 0.28%. For the Nasdaq index, it is down 1.33%. And finally, for the Dow Jones Index, it is down 0.76%. The markets are just slightly down this week as news comes out in hopes of finding a potential vaccine for the pandemic, in addition to earnings being released by major companies showing that their earnings have not been as low as analysts have thought. In addition, Congress has created a proposal for a new potential stimulus bill in order to help the economy. As of this recording, there have been over 16 million confirmed cases of COVID-19. Looking at the logarithmic scale, the scale continues to go up and up as more and more people become infected with the virus. Looking at the daily cases, again we see a similar story. The number of daily cases continue to go up and up on a global scale. This is very bad news for the overall world economy and especially here in the United States. This map right here shows the amount of active cases throughout the entire world, which is pretty similar to the amount of incidents. The amount of fatalities are a little bit less than the amount of confirmed cases, which is to be expected. However, this number is always trailing behind the total confirmed cases. Moving onward, the federal moratorium that has protected millions of renters from evictions since March has expired this past Friday. As a result, millions of people are at risk as the pandemic continues to spread across the country. This moratorium was covering renters who lived in homes with federally backed mortgages. The government estimates about 12.3 million households, or about 30% of renters, who are covered by this moratorium. Unfortunately, since this moratorium has ended, landlords are now able to give any delinquent tenants 30 days notice before they are evicted in late August. This expiration of the federal protection may come as state and local eviction bans are also starting to expire, and enhanced federal unemployment benefits that kept many renters afloat are scheduled to end. Unfortunately, this puts more pressure on renters already barely scraping by. The government must step in, or else there will be over 12 million people left homeless. If you or someone you know who may be in trouble with losing housing due to late rent, then please use www.don'tgetkickedout.com. This website right here is a great resource for those at risk for being evicted. In other news, the 18 weeks of unemployment benefits due to the pandemic have expired. Now, Republicans and Democrats of Congress must decide how to extend these benefits or replace them with something else. On the Republican side, they want the economy to start up again by creating incentives for people to go back to work. Therefore, the Republicans plan to cut or eliminate unemployment benefits and instead allocate money for hazard pay and payroll cuts. On the Democrat side, they want to extend the additional $600 a week of unemployment benefits because it would be an awful thing to cut off Americans who need financial support the most. In light of this, the CARES Act, which was the $2.2 trillion stimulus package, authorized $600 a week of enhanced unemployment benefits and is set to expire at the end of July. Now, there are several options that Congress can do in order to address the $600 a week of unemployment benefits. Option 1, Congress does not extend unemployment benefits. This would be extremely terrible as millions of people have lost their jobs, are unable to pay rent, and are about to be kicked out of their homes as shown in the last article. Option 2, use a stopgap measure for unemployment benefits. Since Congress hasn't finalized the proposal for unemployment benefits, Congress can use a stopgap measure as a bridge to continue unemployment benefits at the current $600 a week rate. This would mean that recipients can continue to receive unemployment benefits and buy Congress a little more time before rolling out the final proposal of these unemployment benefits. Option number 3, extend unemployment benefits but cut the amount. This is very popular among Senator Republicans. They do not want to extend unemployment benefits. However, they are willing to negotiate a reduction of these unemployment benefits going back from the $600 a week to approximately $200 to $300 a week. In a related article, Treasury Secretary Steve Mnuchin said that unemployment benefits would be based on an approximately 70% wage replacement. However, this doesn't make any sense as most people are not paid on a salary income. Rather than they're paid by the hour, a lot of them range from the most basic of minimum wage to an upward amount. Alright, so as I was recording this video, Mitch McConnell and the Senate Republicans have unveiled their new stimulus bill titled Health Economic Assistance, Liability Protection, and School, or HEALS Act. I'm going to go over things like direct stimulus payments, unemployment benefits, school funding, and payment protection program loans. Overall, this proposed bill is a good starting point to help Americans, but Democrats will most likely want a lot of changes before it's passed because it falls short on so many other social economical problems caused by the pandemic. Things like hazard pay for essential workers, housing, funding for food stamps, and many more are not included in this bill. Let's talk about things in this bill. First off, this bill has proposed $1 trillion in the new stimulus package, as people need more help. Here is what's in the $1 trillion stimulus package. Direct stimulus payments. The HEALS Act includes another $1,200 of stimulus checks. Eligibility for the second stimulus checks are similar to the first one, but not entirely the same. For starters, individuals who make $75,000 capped annually or married couples filing jointly who make $150,000 capped annually will receive the full $1,200 stimulus check. Those that make above this given threshold will see a phase out of the checks just like in the first stimulus bill. Individuals without income or who rely on SSI benefits will still be eligible to receive the $1,200 stimulus check. Unlike the first stimulus check, there will be no age limit for eligible dependents to receive the additional $500. If you recall, the first stimulus check had a stipulation that dependents must be 17 years or younger to be eligible for the $500 stimulus check. Also, this second stimulus check appears to not have a limit on how many dependents can be claimed. If you recall, in the first stimulus check, there was a cap of 2 dependents per household. There is also restrictions on who receives the stimulus checks, which includes people who are deceased or who are prisoners. If you recall, in the first stimulus check, there was that mess where people who were either deceased or who were in prison were getting stimulus checks, and this time, the Republicans do not want that same mistake to happen. Next, let's talk about unemployment benefits. According to this new HEALS Act, unemployment benefits are to be cut from $600 to $200 weekly. In replacement of the additional $600, the GOP plans to have a 70% wage replacement scheme to be implemented for jobless people. However, it should be noted that this 70% wage replacement scheme will be extremely difficult to implement, and here is the reason why. The states require at least about 8 weeks in order to get the new implementation of unemployment benefits rolled out by the Republicans. The HEALS Act would only allocate $2 billion for state workforce agencies to upgrade their computer processing systems. This lag time between switching over from the $600 a week to $200 a week in order to do the 70% wage replacement payout can cause major strain for many people because there are a lot of workers to consider. Unlike traditional salary workers, self-employed and gig workers often have volatile incomes and are not automatically reported to state workforce agencies. Therefore, the state workforce agencies would have to request that information from an applicant using their 1099 tax forms. These tax forms are incredibly hard to get a hold of, and with millions of people in need of this benefit, it will take a very long time for individuals who require unemployment assistance to get the help that they need. Moving on to state aid, the GOP plan offers minimal to no relief on the city, county, and state levels. This news unfolds despite many months of pleas from local government leaders who sought out $1 trillion in new federal aid. Instead, the GOP are only allowing states to use the existing $150 billion funding that was passed in the last relief bill known as the CARES Act. In terms of funding for education, the GOP plans $105 billion for school funding. This funding will mainly target schools, which will open up for in-class instructions. Schools must also follow minimum requirements for safely opening their doors to students in order to receive funding. In terms of health funding, the following will be allocated to help combat against the pandemic. Number 1, $16 billion in funding for testing. Number 2, $16 billion for the NIH. And number 3, $3 billion for the CDC. Next, let's talk about the PPP loans. The HEALS Act will expand a second round of PPP loans, which will also be forgiven, assuming that business owners follow certain conditions. In detail, an additional $100 billion of long-term loans to businesses has been extended. The new amount totals up to $190 billion of available funding. However, there are some requirements. For one, the business must have 300 or fewer employees. And for number 2, the business must be able to show that there has been a revenue loss of at least 50% due to the pandemic. Lastly, we'll talk about liability protection. Many businesses, hospitals, and other organizations are worried that if things reopen, there could be a potential for many lawsuits due to the pandemic. In order to combat these fears, Mitch McConnell has included in his bill a Liability Shield, which is a 5-year liability protection for businesses, schools, and hospitals from being sued from viral damages due to the pandemic. However, trying to implement this Liability Shield will be very difficult and is very unclear how it would work in the future. Next, let's look at some of the major earnings that have come out this week. The big names in tech that came out this week were Apple, Facebook, and Amazon. For the fiscal third quarter, Apple has reported a revenue of $59.7 billion. This translates to an 11% year-over-year growth. Its earnings per share has jumped up 18% year-over-year to $2.58. This blew away analyst consensus, which forecasted a 2.9 year-over-year decline in revenue and an earnings per share of just $2.04. Apple has reported a sales growth in all of its product segment, which therefore gave it a gross profit margin of 37.5%. Moving on, Facebook reported an 11% year-over-year increase in revenue, leading to an earning of about $1.80 per share. Analysts on average were expecting a revenue rise of just 3.1%, and the consensus was that they would have an EPS of $1.39. As reported by this article, active daily users on Facebook rose 12% year-over-year to 1.7 billion daily active users, and therefore they experienced a growth of 15% year-over-year to about 2.47 billion users. Lastly, Amazon has been destroying the competition. As many of you are aware, due to the pandemic, many people are staying at home and are not going outside as much. As a result of this stay-at-home order, many people are ordering from e-commerce sites. One of the big main players of e-commerce would be Amazon. Just from this quarter alone, Amazon surged 40% year over year to $88.9 billion. Analysts on average were expecting a revenue increase of just 28.6% versus the 81.5 billion, and the EPS that was reported by Amazon was $10.30 compared to market analysts forecasting only $1.46. So this means that overall Amazon is destroying the competition. Year over year, it's raised its revenue to over 40%. It earned 10 times its earnings per share and has a huge market cap and revenue stream of $81 billion. So, if you're looking for stocks to try and make a profit, I would heavily do my research in stocks such as Apple, Facebook, and Amazon because these are some of the big key players starting from now until the end of this year. Now, in contrast, one company that's recently getting a lot of popularity this past week is Kodak, a company that I'm definitely not buying into, as if we just look at the charts here, we can see that there was a lot of swings back and forth from the rally of this company. Taking a look at this graph right here, the company's shares have skyrocketed based on the news that it would be transformed into a pharmaceutical company. The company jumped more than 200% on Tuesday, and the rally continued onto Wednesday as the shares ended up over 300%, causing 20 circuit halts in the trading on the New York Stock Exchange. The traded stock since then has raised over in price by thousands of percents and ended the day at over 900% in increase. Now, it's good that more companies are working towards weeding off the United States' dependency on foreign companies. However, Kodak may not be the best place to invest when there are so many other well-established companies that can do this job of producing generic drugs much more efficiently and cost-effective. Now, I'm sure everyone is aware of Kodak. Kodak is an American technology company that produces camera-related products with its historical basis on photography. However, most people are unaware that Kodak also used to be a company within the pharmaceutical industry producing key ingredients for generic drugs. The reason behind Kodak's enormous rally is due to the Trump administration announcing that Kodak will be transformed into a pharmaceutical producer under the Defensive Production Act. In addition, Kodak is receiving $765 million in loans in order to launch Kodak Pharmaceuticals. Through Kodak Pharmaceuticals, it will produce generic active pharmaceutical ingredients to reduce America's dependency on foreign drug makers. Now, let's go over to look at my M1 Finance portfolio. Specifically, we're going to look at the healthcare sector. In this pie, I have a lot of companies within the healthcare space. Specifically, I want to take a look at Merck & Co., Novartis, Eli and Lilly Company, Bristol Myers Squibb, and Johnson & Johnson. These companies are all key players within the biotechnology and pharmaceutical industry. Specifically, these companies are within producing and marketing prescription and over-the-counter products. By that, I mean think of daily products that you find in the grocery store, such as Advil, Tylenol, or Robitussin. And these companies do much more than just research, develop, and sell prescribed and over-the-counter drugs. They have drug patents, household goods, vaccines, and much more. The large companies mentioned are already in fierce competition with each other. Kodak hasn't participated in the pharmaceutical space for a while, and expecting it to do extremely well is most likely wishful thinking at best and financially irresponsible at worst. So, most likely it's better to invest in companies which have a long-term track record of doing well in their specific niche rather than doing a speculative play hoping for the best. However, the play on Kodak is interesting and I will definitely keep an eye out on this company, but as of now, it will definitely not be within my portfolio because there's way too much risk involved. Now, let's take a look at my overall portfolio. This is my M1 Finance account, specifically my Roth IRA. I've made a lot of changes to this account. Specifically, if you've noticed in my past videos, I had a lot invested in the energy sector. However, due to this pandemic being extended for the future, I allocated the majority of the energy sector and placed it elsewhere in different sectors because rather than losing money on this sector, it's better to utilize that money elsewhere and try to make profits where opportunity arises. Overall, this portfolio isn't doing too bad. It's only down about $700, $800, and overall, the performance of this portfolio is doing pretty well. If we take a look at the all-time charts, it says that I'm down about 14%, which isn't a huge loss. For the past year, my portfolio is down 12.04%, which is a loss of about $880. For the past quarter, my portfolio is actually up 7.72%, which is a gain of about $645. For the past month, my portfolio is up 1.76%, which is a gain of about $150. For this past week, my portfolio is up 0.01%, which is about 60 cents. And then for the past trading day, my portfolio is down 0.11%, which is a loss of about $10. So not a huge deal here. However, there was a lot of trading going on within this portfolio, and we'll take a look at that next. So on this tab right here, we can take a look at the trading that has taken place in my portfolio. Over here, I sold out of these specific companies, which you might have saw in my last video, and bought these companies instead. The reason behind selling all these companies right here was the majority of them had already cut their dividend. However, their stock price has gone up to levels where I can make a profit, and I decided to sell off on all of these companies, ones which I had been profitable but had already cut their dividend, and reinvest them into these companies over here, ones that are either fairly priced or have a slightly high evaluation on their price. However, they all have in common is that they all pay a stable dividend which has been trending onward for over 10 years. And I'd rather have that stability over certain profits only to find out later that the dividend is cut. Same thing with the trades over here. I traded out of these companies right here because their evaluation was just way too high and their stock price has been plummeting. In addition to that, these companies right there have cut their dividends, and so I wanted to allocate the money that I had in these companies into these more stable companies right here. Lastly, for this past trading day, I decided to do something a little bit more drastic. I sold off a huge portion of my energy sector and allocated that money over into these big tech companies and some of the companies in the industrial and communication space. I did this mainly because I don't know how long this pandemic will last, and I do not want to see the value of the hard-earned money that I put in to just slowly wither away and evaporate. By moving money from a sector that I see that is doing extremely poorly and may not recover for a long time, and instead transferring it into well-known companies, specifically tech companies, which are able to perform despite a pandemic occurring, I think this is a much safer play and will produce a lot more dividends as well as capital appreciation. And that's pretty much it for trading activity in this portfolio. Let's take a look at the dividend payout. So in this portfolio, we had a decent amount of payouts for the last 2 weeks. Just recapping some of the payouts, I earned 6 cents from Xcel Energy, $1.06 from Cisco Systems, 7 cents from Comcast, 1 cent from Romper Technologies, $2.90 from Simon Property Group, 29 cents from Cisco Corp, 64 cents from Ben Franklin Resources, 30 cents from B&G Foods, $6.18 from B&G Foods, 2 cents from One Liberty Property, 8 cents from WD-40, 7 cents from Chimera Investment Corp, 10 cents from Edison International, $8.37 from Gladstone Corporation, 1 cent from Humana, 57 cents from JP Morgan Chase, 35 cents from LTC Properties, 3 cents from NRZ, $1.66 from New Tech Business Service Corporation, and 2 cents from One Liberty Properties. The dividends that I earn are a result of me owning shares of each company. This is money that I did not have to put any effort into earning besides clicking a few buttons to buy shares. Essentially, I'm earning money while I sleep, and this is referred to as passive income. Earnings which are derived from an enterprise like a rental property or company
which require little to no effort to earn and maintain. Although these amounts may seem small, every little bit helps and will eventually snowball into something bigger through compounded interest. Now, since it's the end of the month, let's take a look at my portfolio on how it stands based on its dividend growth. If we take a look at this page right here, this is a dividend tracker that I use in order to track the dividends produced in my portfolio. As you can see here, in the month of July of 2020, my portfolio has produced over $40 in dividends. Just taking a year-over-year look, this is more than 4 times the amount that I earned last year through this portfolio loan. And looking back just 1 month, that's $10 more than it earned last month. Progress is going pretty well with this portfolio. If we took a look at this right here, this is the quarterly dividends. Basically, I track how much dividends this portfolio is producing on a quarterly basis. And as you can see, it is trending upward very nicely. Of course, we have just started the first month in Q3, so this portion of the graph has tapered off. But just looking over here, Q3 has already done much better than last year's Q3. And this is only just from 1 month. This is from the 3 months. This is just from just 1 month. So we have a long ways to go, and I'm pretty sure that this quarter will easily surpass the previous quarter. And I'm really excited to see what will happen next. So this concludes the update portion of my portfolio. If you made it this long through the video, then I greatly appreciate it, because this video took me a really long time to make, especially with all the information continuing to roll out. I know a lot of channels like to post videos about whatever is cycling through the news. However, my approach is to take a look at everything comprehensively and give you the important and straight facts, rather than just creating clickbaity titles and thumbnails. So if this video has either helped you in some way or has inspired you to start your own investment journey, then please give this video a thumbs up. It really helps me out with the YouTube algorithm. And if you have any comments, questions, or concerns, post them down in the video below. I read all the comments and I'll do my best to respond to any of them as best as I can. In addition, if you have any comments for me to improve my video content, then drop some comments down below. I will definitely read them, think about it, and see what I can do in order to improve my videos. Thank you so much for watching and staying to the end. I'll see you guys next time. And I hope you all have a great day.